All right. I keep telling everybody we need to do tax planning, and most people don't know. It's a fancy word. It goes for companies. It goes for somebody who's large. Tax planning is for everybody. So I guess the first thing you have to think about is why is tax planning important? What is tax planning? And it's part of your overall financial planning for everything you're going to do. It's not necessarily making all of your taxes go away. Because if we made all your taxes go away, then Kathleen can't sell you or get you a loan to buy a house. Or you can't buy a car. You can't get credit cards. Everything you do has tax implications, and it's a matter of intelligently looking at what is going to happen in the future and making decisions now to reduce your taxes without affecting your future choices. And there's a great way they put it. There's a gentleman, you might have seen this on the front of my Facebook thing. This is Billings Learned Hand. Long years ago, he was a Supreme Court judge for 52 years, back before they had the tax courts. And his quote was, in America, there are two tax systems, one for the informed, and one for the uninformed, and they're both legal. So you got to decide, how's that going to affect you? And what does that look like? What does tax planning mean for an individual in this room right now? Not a big company who's trying to move money and stuff like that, but what would it be for you? So in Huntington Beach, 2010 census numbers, so these might be a little bit out of date, there are 61% homeowners. More than half of Huntington Beach owns a house. Average per capita income per person is a little over $42,000. Actual average income for a household is a little over $82,000. So numbers don't quite mesh, but their average household is 3.01 people. I don't know what they're doing with that 0.01 person. But yeah. Average house in Huntington Beach costs about $638,000. So if you're putting 20% down, you have a mortgage of around $510,000. And for the matter of this thing, I took a look at, if I had purchased the house in July of 2012, I'd be running about a 3.89% APR on a APR? No, fixed interest. She's over there shaking her head going, no, that's not it. My interest rate. So let's meet Mr. Scott. I was sunburnt that day. Shelley had a horrible time trying to get good pictures out of us.
For 8 hours before they get their portrait done. Look,
well,
we made it work.
Yeah, we made it work, and they turned out beautifully. Go get pictures done by Shelley. So if I was doing bookkeeping, I used some average numbers here. $75,000 in income, that's about average for a bookkeeper. It is modern, so I've increased my final number here to about 38 instead of 42, but it's still within average for Huntington Beach. And as you can probably guess, this is not enough to buy a house. So I need a second income, so we'll have not yet Mrs. Scott here. Not yet Mrs. Scott is an administrative assistant, because if she was a teacher, it makes it a whole lot more complicated because they have their own pension plans and everything, making $42,000 a year. And, you know, we are young, so we end up with a couple of kids. So if I've got a big Scott Jr. there at 16 and a little Scott Jr. there at 14, with everything we've said, this is what my taxes would look like. So if you just walked into, I won't use any names, you just walked into a tax preparation firm or bought a piece of software offline, typed your numbers in, well, I'm sure our loan officers can tell you the first problem is you only have $100,000 in income with a $500,000 mortgage, so that's a big problem. But your taxes for the year will be about $12,000 after everything works out. So let's do some tax planning. The first thing you're going to want to do is, are you picking up all the money you have? A lot of people leave money behind. You have, some of you are employees of different companies, some of you have memberships at Costco, AAA, anything like that. All these companies have benefits that most people do not use. I'm trying to think of them offhand. You know, your HR people, you're looking at whether or not you have retirement plans, whether or not they give you discounts when you take your kids to Disneyland. Same thing you can get with Costco, AAA. All these companies give you all these extras that you may not know about. If you don't use our esteemed Mr. Eric Evans here and happen to get your insurance from a lizard, Their company is owned by a conglomerate. If you go and spend $20 to buy a single share of their stock, you're considered an employee and you get an employee discount. There's lots of little things you have to look at for picking up. We'll do it simple. We'll just take a look at Mrs. Not Scott so far. Mrs. Not Scott has a 401k she's not taking advantage of. Always take your 401k. Not only do you get retirement and it comes out pre-tax, which I'm sure Ron will tell you is a great idea. Don't pay if you don't have to. But your employer matches it most of the time, which means they're giving you free money. Your employer's trying to give you money and you're not taking it. Another thing, and this one his wife may not like to hear about, is the group health insurance. If you are self-employed and your spouse or one of your jobs offers group health insurance, you cannot take the self-employed health insurance deduction on your tax return. It disqualifies you. So if they offer it and you want to take advantage of Miss Crystal, put her in touch with your HR department and get them to sign up with her for group health insurance. Try not to pay for it yourself because you know you're leaving money behind. You're not only paying out of pocket for the health insurance plan, but you don't get to deduct it and you're not taking advantage of your employer's contributions. So just taking those two, if they had a 4% 401k and they were paying out of pocket, I think I calculated $350 a month for their insurance, that means changing it will reduce Mrs. Not Scott's take home by about $4,800. But in exchange, she's getting a $2,400 put into retirement for her and an additional $4,200 that they were spending out of pocket on insurance that was not deductible. And it reduces their tax by $800. So if you just take, the top and bottom numbers here, basically she's been giving $2,400 in retirement and $800 in discounts on their taxes. So don't leave money behind. And if you're wondering how that affects their income, we've changed that from about $1,300 to just under $1,200. 2 minutes already? More things I have to go through. We'll do this quick then. Next thing is don't miss out on deductions. Biggest one is in-home office. They have a new simplified method. If they have an 1,800 square foot 4-bedroom townhome in Huntington Beach and they're using one room of about 150 square feet, the simplified method would be $750 deduction. I calculated out normal expenses and it ends up about $1,200. In this particular case, it would make more sense for them to go the traditional method, but not always, because one of the things that's missing in this calculation, it's actually done on the taxes side, but you don't get to see that part, is if you take the simplified method, you still get to claim the full amount of your mortgage interest on your Schedule A and the full amount of your real estate taxes. And in the future, when you sell your house, you do not have to recapture depreciation from in-home use. So this is definitely something, if you're going to do in-home office, talk to your accountant before you do it. That quick little change drops their taxes down by about another $800. Now is spending money. Sometimes you have to spend money to save money. It sounds counteractive. But they've got 2 children under 18. If you have an underage child with a Schedule C or a partnership that is owned by the parents, they do not have to pay any of the statutory taxes on their payroll. So if you have 15, 16-year-old kids, you can hire them to come work in your office. You pay them. You do not have to withhold Social Security, Medicare, FUTA, SDI. And you also don't have to pay the employer side of them. On top of that, they still get the standard deduction. So if their pay is under $6,100, they have no taxes for the year. With one kid, that means you're now taking $6,100 off of your income, and it's just gone. You do have to still write them their check. Always have the checks pay out, so that way you can show the IRS that you did pay it. And the best thing is you can take those checks, put them in a checking account for the kid for the benefit, and then pay their expenses you don't get to deduct. Karate, school trips, clothes. The kid can pay for all that through the payroll you've given them, and suddenly you've made deductions out of personal expenses. It's all legal as long as you have the kid actually do some work. So if you have 2 kids, yes, do some work. Well, that right there reduces it down to $7,000. One last one, Ron's favorite, is retirement here. As a self-employed person, you basically have 4 different categories you can go into. An IRA, anybody can do. Limit is $5,500 per year, and you have to have your AGI under 95. If you saw at the beginning of this, their AGI was 97, so they couldn't do an IRA before tax planning. Now they can because we've reduced it. SEP IRA is limited to 20% of your self-employment income. Simple IRA is $12,000 plus a $2,500 catch-up if you are upper age. 55 off the top of my head, I want to say it is, or older, you can do catch-up to help with your retirement. Solo 401k, of course, has the most. A $7,500 contribution, a $5,500 catch-up if you're older, and a 20% self-employment pension contribution portion. In this case, if you look at the last time we were looking at their money, their taxable income was only $5,600. It changes slightly because when you reduce the income, it's going to reduce your itemized deductions. But so if I go ahead and bring $1,700 in as adjustments, they have no taxable income, and the only thing they have to pay is their self-employment tax. So this is where they end up. We've reduced our payroll by $4,000 and contributed $17,000 in. So there is some cash out. There's some cash flow items. In exchange, they now have a $19,000 retirement account. They've reduced their out-of-pocket expenses by $16,000, which almost offsets that, and reduced their taxes by an additional $6,800. So if you look at these numbers realistically, by doing some tax planning, their additional cash flows just about match their tax and reduced expenditures. So they got a free retirement account. That's what tax planning is all about, is just making sure you take advantage of what you're doing. And that's it.